Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm thrilled to have with us Antonio Juliano, who is the founder and CEO of dYdX. dYdX is a leading decentralized exchange, and they've been a pioneer in both the financial instruments that people can trade, as well as the infrastructure on which the exchange functions and where the money travels. And I'm really excited to learn from him today. With that, Antonio, welcome to the podcast.
Hey, thanks so much for having me.
My pleasure. So you've been in the Web3 crypto space for a while, right? One of your earlier jobs was at Coinbase. How did that happen?
That's right, actually. And I've never worked not in crypto, to be honest. So I started at Coinbase about 8 years ago at this point, almost. And I got to Coinbase pretty differently than most people got there. Back in the day when I had joined Coinbase in 2015, there was really only Bitcoin was kind of the main exciting thing happening in crypto. It was very different than kind of the multi-chain, multi-technology world we live in now. So pretty much everybody who got to Coinbase at the time was really into Bitcoin. And then that naturally led them to Coinbase as one of the most exciting and best companies in the space, especially at that time. So when I got there, I didn't really know very much about crypto at all. They had to teach me what's a hashing function, how does mining work, all these kind of different primitives. And over time, I think just the enthusiasm everybody had for crypto at Coinbase really started to rub off on me. And I started to get super excited about it as well. I think the main watershed moment that happened when I was at Coinbase was Ethereum was launched. And this, I think, took all of us a long time to wrap our heads around. What is Ethereum, especially at that time, because nobody else really understood it either, besides some of the founders and early adopters. But I think after I had wrapped my head around the fact that Ethereum enables a fundamentally new model of computing, where for the first time you can write these programs that are just open source code and that just execute on a blockchain and aren't controlled by anybody. And that got me pretty excited. I kind of came to dYdX from a lens of I'd always wanted to start a company. And then this enthusiasm I got for crypto through Coinbase, I think really convinced me that there was going to be something big here long term. And then after I wrapped my head around Ethereum, I was pretty convinced that I wanted to build something on top of Ethereum, wanted to build smart contracts. And I was just convinced that there had to be something really fundamentally valuable that was uniquely enabled by this new technology. And then after a brief stint at Uber and another kind of startup that I briefly worked on that didn't quite work out as well, I started dYdX.
Before we get to dYdX, and we definitely will, I feel like now is an appropriate time for a joke about the rate of change in the conversation at which we will get to dYdX. Hopefully, that's a joke for somebody in the audience. I want to kind of feel this moment when you're at Coinbase, right? So it's like 2015 to 2016. Ethereum hasn't really launched. People who own Bitcoin are kind of seen as weirdos. How many people did Coinbase have at the time? Do you remember roughly?
I was about the 100th employee of Coinbase.
Yeah, now they've got 1 million employees, I think.
Give or take.
Yeah, give or take. 100th employee, and you're like a software engineer. And Coinbase is like all about, this is the base for all your coins, and you can come here and you can trade them for money. And if you buy them, then you will have the coin future. And out comes Ethereum with this idea of write software on a blockchain network. Did it make sense to people in the context of trading coins around on a centralized exchange? Like, you already have an infrastructure for trading. Do you remember how people conceptualized and thought about this other platform, or like the Ethereum version of the world? Like, what did it feel like to you?
So I think the thing that you really have to imagine is if you're in crypto at that point in time, just how dominant Bitcoin was. both from a literal market cap perspective, but especially from a mindshare perspective. Like I mentioned, and this isn't true for everybody, but at least as a new grad working in crypto in 2015, we were all convinced that Bitcoin was going to be the only, or at least the main thing that was going to be interesting in crypto for forever. And I had heard some about Ethereum even before it launched. One of the really great benefits of Coinbase was that there were tons of other amazing people there at the time, like Olaf, who has since gone on to found Polychain, would give tech talks on gas usage and smart contracts and this kind of stuff. And I remember being pretty confused by it at first, or didn't quite understand exactly how it would work. And I think the second thing that was really surprising about Ethereum was, well, first of all, they had really big ideas, right? And you have to wrap your head around a bunch of new concepts like gas usage, like smart contracts, like the virtual machine that they had built. But the thing that really surprised me, and I think everybody else at the time, is how well they executed on it. It was like, okay, guys, you're going to make this new blockchain, an entirely new virtual machine, an entirely new programming language, and all these new concepts, and you're going to ship that in a year or two. Okay, come back. Let's be serious now. Come back in 10 years when you're actually done with it. But that was kind of the miracle of Ethereum, I feel like, is that it did launch and it did work really well. And the EVM is still the most widely used smart contracting VM. Solidity is still the most common programming language for smart contracts years later. And I think that gave a lot of people pause and caused them to take notice. In terms of, so I think it took people maybe a year or so to figure out what the heck Ethereum was. And then there were some early things that started to work on Ethereum. And the most notable ones in my mind that started to work were decentralized exchanges. I was kind of fortunate to get to know Will Warren, who's the founder of 0x, sort of one of the super OG dexes. And it was that was kind of the next step I had to wrap my head around. It was like, okay, fine, I get there's this new computing model where you can put stuff on a blockchain, but what is a decentralized exchange? Why would people be excited about that? And how is that ever going to be better than Coinbase? And I think I, like a lot of people, was skeptical at the time. But looking at things like that, and after I had kind of wrapped my head around it and thought to myself, hey, this actually is something that could potentially be really useful and is fundamentally different, just a different way to trade. Is there something that could be built on top of this, or what comes next after your kind of normal spot-based decentralized exchange? And that's kind of the genesis for the idea behind dYdX. It's like, okay, now we have decentralized exchanges. What comes next? It's like more advanced financial products like margin trading and derivatives.
You're working at Coinbase, you're seeing all of these new assets come online. One of the assets happens to be programmable, and a year later, you are starting, forgive the representation, but a Coinbase competitor on this programmable platform, right? So you're like, we can do the exchange work, but on a decentralized computational platform. Can you give us some definitions in terms of what decentralized exchanges are, right? So there's just the basic point of, well, the software runs on a computational network, which has a decentralized technical architecture, or, like the hardware is literally in many places and the network's anti-fragile. But can you talk about the shapes of decentralized exchanges, the automated market maker shape, the order book shape where it functions, and then the directions? How did you navigate what those shapes are?
Yeah, absolutely. Well, I guess since we were talking about history, we can kind of take it piece by piece. So I would define a decentralized exchange as any kind of trading platform in a broad sense that's powered by smart contracts. And I always say smart contracts are just a fancy word for programs that run directly on a blockchain. So back in, I'm not sure exactly when they started, but I think 2016 or so, the very first decentralized exchanges started to come out. This was things like 0x. There was one called Kyber, Ether Delta, things like that. And people originally started building order books for their liquidity model for their dexes. And this ran into a lot of challenges because generally of the performance of blockchains, as we all know, are just not really very scalable. And order books and matching engines require super high throughput to operate. So it wasn't really a natural fit for decentralized exchanges, especially at that time. I think the next key innovation that happened in dexes was automated market makers. So this was kind of popularized by Uniswap, obviously. Even like Vitalik and some people at the Ethereum Foundation had been kind of theorizing about how automated market makers could exist before they were even built. But these have obviously become a huge player in the decentralized exchange space. And I think there's a couple interesting properties of automated market makers. The first interesting property is that it just makes LPing or providing liquidity much, much easier. So normally, if you're trying to trade traditional assets, there's just no way an individual person could ever become an effective market maker. This is a very professionalized business, and there's no way you could compete.
We're using these words, so might as well define them. What is liquidity and what is a market maker?
Sure. So liquidity refers to the ability to just like who you can trade with. So say you wanted to buy some Apple stock. Well, who's going to sell it to you? So that's what liquidity is. Liquidity is a really fundamental and important concept in markets because generally the more liquid a market is, the higher quality it is as well. So in terms of market makers in traditional finance based on an order book model, who are you actually trading with? Like if you go trade on Robinhood or something like that, you're trading with these fairly professional, usually firms who are running these quote market making strategies. And they'll basically just offer to buy or sell a given asset at a certain spread. And that's kind of how they make money. So it's like, okay, well, if the price of Apple is $200, they'll sell it to you for $201. It's a very simple example. It's a lot more complicated than that, but that's kind of how it works at a high level.
You were talking us through the different shapes of decentralized exchanges that have been invented and how that was happening.
So that's how it works in traditional financial markets is with market makers, but Uniswap and others popularized the automated market makers. And the key innovation there is just you can deposit your funds into a pool and it automatically market makes for you. And then you can earn spread and fees based off of people who come and trade with you. These have become really useful because they are pretty effective at building liquidity, especially for long tail markets. What I mean by long tail markets are kind of the markets that aren't as popular, don't have as much trading volume. So therefore, like the real sophisticated market makers are oftentimes less interested in quoting on them. But with an automated market maker, anybody can spin up a new market super easily and start providing liquidity just by clicking a button. So AMMs have become pretty popular, but at dYdX, at least now and for the foreseeable future, we are focused on order books. So that's kind of the first thing that I was talking about. And I mentioned some of the drawbacks of order books when you kind of combine them with DEXs in terms of blockchains are really not very scalable. So it's really hard to build an order book onto a blockchain because what is the main operation that's happening on an order book? It's market makers basically placing and canceling orders all the time. And these usually happen not through a human placing and canceling orders, but with trading bots, and bots can run really fast. So the kind of innovation that we came up with and popularized at dYdX is that you can have an off-chain order book. So you actually don't have to put the order book on chain, but then whenever anybody trades with each other, then you put those kind of settlements on chain into the smart contract. And that's how dYdX works today. The big thing that we're working on right now, and we can touch a lot more on this later if it's of interest, is fully decentralizing dYdX. And actually, the biggest component of that and the core thing that we're working on is building a fully decentralized order book and matching engine that is really high quality and is really performant. And that's never really been done before.
I do want to get to that, but I first want to kind of pull apart also the differences in decentralization, right? So you can have the decentralization of the blockchain on which you have software that you deploy, but the software might be quite simple. Then you might have like a multi-chain infrastructure or like a rollup infrastructure, or you might also have decentralization in the human organization that you're building, where it's no longer just a particular company, but it is a community or a community governed project and so on. And I feel like in crypto, a lot of these things have gotten bundled together. Can we talk a little bit more about your marquee product, the perpetual? What is it and why do people like it and how does it work?
Yeah, absolutely. So this is the main and actually only product that dYdX offers right now is a perpetual. And perpetual contracts are a type of derivative contract that have really been popularized within crypto kind of for the first time. And kind of the inventors, or at least popularizers of this type of financial contract, were BitMEX back a couple years ago. And fast forward to today, perpetuals are by far the most widely traded asset in crypto. The trading volume for perpetuals is roughly twice or even more trading volume than the entire Bitcoin and rest of the crypto spot market combined. So they're already huge. And let's first talk about kind of what they are, and then I'll touch on why they became so popular. So a perpetual contract, or any type of derivative contract, is just a synthetic contract, which means that when you're trading these contracts, you're not actually trading the underlying asset, or the underlying asset is not involved at all. So let's take an example. Let's say you're trading a Bitcoin perpetual and there's no actual Bitcoin involved, but it's this kind of synthetic instrument that is collateralized on dYdX. Our collateral is held in USDC, for example. But then you can trade this asset, which effectively trades at the price of Bitcoin. And the mechanism through which this works is actually pretty simple. It's this concept called a funding rate. And what a funding rate is it's effectively a dynamic interest rate between those who are long the contract and those who are short the contract. Long just means you make money when the price of Bitcoin or whatever the asset is goes up. And short just means you make money whenever the price of the asset goes down. And there's always exactly as many units of long of the contract as there are units of short the contract. So the whole contract is effectively zero sum. Like, some people will make money and some people will lose money. And this funding rate is important because it's the thing that tethers the price of the contract to the price of the underlying. So let's take an example. Let's say the price of Bitcoin is $20,000 and the price of the dYdX Bitcoin perpetual is $21,000. This is just an example. Normally it would never get that far away in price, but just for clarity. So what do? The price of the perpetual is now too high, right? It's $21,000, and we want to push it back down towards the actual price of Bitcoin, which is $20,000. You use the funding rate. And in this example, you would have those who are long the contract pay those who are short the contract some dynamic interest rate. And why might you do this? Well, if the people that are long are paying the people that are short, it incentivizes more people to go short and sell, right? So it incentivizes selling and drives the price of the perpetual back down to the $20,000. Conversely, if the price is too low, you just do exactly the opposite thing. You have those who are short the contract pay those who are long the contract, and it drives the price back up to the price of the underlying. Another really cool and important property is kind of in the name, actually, perpetual, meaning that these contracts never expire. So it's fairly different to trading like a traditional future or a traditional option or something like that, which has an expiration date. These perpetuals never expire, and you can hold them as long as you want and keep trading. And this kind of brings us to the next point, to the next question. So, okay, now we understand at a basic level what a perpetual is, but why should anybody care? Like, why don't you just buy Bitcoin rather than buying a Bitcoin perpetual? And the core concept as to why this is really important comes down to leverage. Leverage is kind of a concept which means you can buy more than you actually own. And what I mean by that is, say you have $1,000 and you want to invest in Bitcoin. The simplest way to do that would just be to go to Coinbase or wherever and buy your $1,000 worth of Bitcoin. But if you used a perpetual, you can take leverage. So you could come to dYdX with your $1,000, and then you can buy $10,000 worth of Bitcoin, for example, or $2,000 or $20,000. Kind of, you can buy as much as you want up until the maximum leverage that's allowed, which is 20x on dYdX. And this is cool because now, let's say the price of Bitcoin doubles. And let's take the first example. If you just bought $1,000 of Bitcoin, pretty simple, right? Now your Bitcoin is worth $2,000 instead of $1,000. But if you had taken on 10x leverage by buying $10,000 worth of Bitcoin, your holdings are now actually worth $20,000, right? And you've made $19,000 instead of just $1,000. And that's kind of the power of leverage and why a lot of people choose to trade these particular products.
Right. And of course, it goes the other direction too. Leverage allows you to wipe out and get liquidated much faster than if you weren't levered up. And of course, we saw a lot of that happening with funds that people thought were invincible, like Three Arrows and so on. Can you talk a little bit about, just to continue to build our intuition about how the product works, can you talk about, because you're essentially, the product needs both sides of the contract to be there. Like, is there a minimum scale, a minimum demand, and a minimum supply that you need, or like long, short for the thing to work? Or like, where are the limits? At what point does the thing start to kind of break down?
There's no limits in terms of how small or how big it can get, actually. Really, it's just a function of liquidity, which is why I was talking about that a lot before. Like, you can buy as much Bitcoin perpetual as you want, so long as there are people that are willing to sell it to you for some price, right? So that's where the market makers come in and where the liquidity comes in. I think right now dYdX has something on the order of $200 or $300 million of open interest. Open interest just means what's the sum of all the positions that are taken on all the markets on dYdX. And then on Binance and some other places, the open interest can get even an order of magnitude or so higher. So there's no limit on how big they can get, and it's really just kind of a function of liquidity. You kind of touched on this concept of liquidations, and let me just run through a quick example of that, just because I feel like that's important to understand the question of how big can these things potentially get. So let's go back to our example. So you came to dYdX or wherever else, and you bought $10,000 worth of Bitcoin perpetual, and you only have $1,000 worth of collateral sitting there to back it. Well, the risk here and the problem, and why everyone who trades with leverage should really try to understand what's going on and take note of the risks, is, well, what if Bitcoin goes down in this example? It actually doesn't have to go down that much for you to lose all your money in this example where you're 10x levered. If the price of Bitcoin goes down even 10%, then you've lost your $1,000, right? And you're left with $0. Whereas if you had just bought $1,000 worth of Bitcoin on Coinbase and it goes down 10%, well, no big deal. You just now have $900. And this is kind of the core concept. And how the system works is, if an account goes down to the point where it's close to zero value, meaning that the collateral has been almost entirely used up to take care of the losses that a given trader may have taken on, then that account will be liquidated. And liquidated just means the position will be forced sold onto the market, whether the trader wants it to happen or not. And this is really important to kind of protect the overall health of the entire system. And if you're kind of asking the question, how big can these things get? Well, they can get arbitrarily big so long as there's enough liquidity to deal with all the liquidations in the event of a big price movement. And historically, that's always been the case on dYdX. No traders on dYdX have ever lost money because the system was fundamentally unsound. But instead, you can often, you just need like a certain amount of liquidity to be able to serve these products. And then there's also an insurance fund, which kind of gets built up as well. From a financial perspective, everything I'm describing here is basically the same as trading perpetuals on centralized exchanges. So kind of the core innovation we've come up with at dYdX is taking all of this financial engineering and putting it into a program that runs on the blockchain rather than just kind of a centralized exchange Web2 type product.
I want to go to how you've used layer twos to do that and how you think about single chains or multi-chain approaches. One last question, exactly in what you were talking about, the implication of somebody having $1,000 in collateral, that being wiped out and sold at the market price, versus, let's say, somebody has a $50 million position or a $100 million position. Like, what's the difference? How does this clear in the current market structure, right? And so the current market structure being that you're selling these chunky positions, I assume, on chain.
Yeah, that's basically right. And the difference is liquidity again, but maybe let's walk through a specific example of what I mean by that. So on dYdX right now, there's roughly a few $1 million worth of liquidity on either side. That means that you can come to dYdX and you can buy or sell a few $1 million worth of Bitcoin or ETH perpetual and not really move the price too much. So in our example, like if you're getting liquidated, well, liquidations happen on the same trading model and the same order book that normal trades happen on as well. So if the system wants to liquidate this $1,000 position, no big deal. It just sells the $1,000, and that's totally fine because there's a few $1 million worth of liquidity, and it doesn't even move the market price or anything like that, and the protocol doesn't realize any losses. But if you're kind of bringing up the example of, okay, well, what if it's a $50 million position rather than just a $1,000 position? This is where it starts to get a little trickier. And one of the kind of concepts that dYdX utilizes, and some other exchanges do this as well, is they require higher collateralization ratios the bigger the size of the position is. And this is exactly to kind of protect against this type of problem. So like if you're trading a $50 million position, don't have the exact numbers right here in front of me at this moment, but you might only be able to take like 2 or 3x leverage, and that'll help a lot when trying to liquidate the position if that happens. Because if you're trying to sell off a $50 million position and there's only a few $1,000,000 worth of liquidity, you can't just market sell $50 million, right? You'll just destroy the price. And that's not good for the trader. It's not good for the system. So kind of our liquidation engine, like a lot of others, is basically smarter than that. It'll kind of take into account what the index price is, how much liquidity there is in the book, and try to sell off the position over time rather than just dumping it all at once. But this is kind of the hard stuff you have to think about when you're doing some of this financial engineering. Like, what's the expected volatility of these assets? What collateralization ratios would be safe? How much liquidity do you need to incentivize on given products? All this kind of stuff is really important.
Yeah, you brought up a liquidation engine, and I can't help but ask you on your opinion about best practices and maybe reflections on some of the mistakes the industry made. And it's in part because the failures of liquidation engines have been brought up a lot in relation to Terra and then FTX, and in basically missing, as there is in crypto, as in certainly equities, when the price drops hard, as a large position exiting, or there's a run on the bank, or it's Silicon Valley Bank, when there's a run on a particular company or project or instrument, there's a sudden collapse in price. And the ability of your liquidation engine to sell into that or to get ahead of that queue is really important. And one of the challenges on chain is sort of like time doesn't really exist, or your oracles, might break, and you might inadvertently end up with some really bad trades. Do you have any reflections on like best practices, and then any color on what had gone wrong in other parts of the industry?
Yeah, for sure. And I think one of the interesting things about a lot of these collapses, like FTX as an example, is that it actually really wasn't their liquidation engine, at least to my knowledge, that messed up. And pretty much all the other major perpetuals exchanges, dYdX included, weathered that event and countless other super price drop days pretty well. It's rather kind of a failure of transparency in a lot of these cases. So it's like nobody knew what collateral assets FTX was holding on their balance sheet. And then once people found out, there was kind of a run on the bank, right? Or let's take a lot of these under collateralized lending platforms like BlockFi and so on. Exactly the same thing. It's not so much that their kind of liquidation engine, if you will, didn't work. It's just that the collateral that was being held wasn't really transparent, and users didn't know what was going on. And we could talk more about this later, but that's one of the pretty cool things about DeFi is that it is totally transparent. So I'd say that's probably the biggest difference. There haven't been any major instances on dYdX and even on Binance where the insurance fund has lost a ton of money due to liquidations not happening, but it is something we have to continue to be vigilant about. And the other thing I'll say is this problem really is not just unique to crypto. I mean, if you look at the traditional financial markets these days, like these bank stocks are collapsing like crazy, faster than any crypto really collapses, maybe outside of like Luna or something. But you have to think about these kind of issues, whether you're in crypto or not. It's just a little bit, more challenging and interesting to think about them in crypto because the volatility is so high. And from a financial engineering perspective, we're doing things in a slightly different way because there's insurance funds, there's not as much recourse against particular traders on kind of an identity basis, and you have to build a system that will kind of be robust no matter what happens.
Let's switch over to the protocol conversation and the types of things that dYdX has done with layer 2s. Can you talk about how you started thinking about layer 2s, what layer 2s are as it relates to dYdX, and then what are the initiatives that have been underway and any learnings that you've had?
Yeah, absolutely. So at a high level, layer twos are basically just more scalable blockchains that are built on top of another blockchain. And this is important because one of the biggest challenges in building in crypto is that things are really not scalable. So I'll kind of walk through the specific story for dYdX and why we chose to build on a layer two, which is how dYdX works today. So I think this was like 2020 or 2019 or so. There was a huge bull market in crypto. That was awesome. Finally, we're getting a ton more trading volume and stuff. But the problem was gas fees were through the roof on Ethereum. So prior to this event happening, dYdX was just a smart contract on regular old layer one Ethereum, and you might have to pay a few cents to make a trade, which is okay, right? Because you're already probably paying more trading fees than that. So who really cares if you're paying a few cents to make a given trade? But the problem was the rate at which gas fees spiked was pretty insane, to be honest. And it got to the point where people were having to pay literally on the order of $100 to make a single trade on dYdX, just because the gas fees were so high on Ethereum. And this was clearly not sustainable. Like, who's going to use an exchange where you have to pay $100 to make a single trade? Nobody. So we thought a lot about this, and it effectively pushed us to be one of the really big early adopters of layer two. And the specific layer two that we're built on is called a Stark-based rollup, or if you've heard the term like zero knowledge rollups, it's very similar to that. We're in partnership with a company called Starkware right now, which is one of the big leaders in this kind of technology. And we moved dYdX from layer one to layer two, I think in early 2021. And fast forward to today, dYdX is by far the biggest application in terms of trading volume on layer twos in the world. And this is really cool because now we've gone back to the world where, in terms of transaction fees, it's on the order of cents or sometimes even fractions of a cent to make a single trade. And that's obviously much more performant, and this helped spur a lot of trading volume.
What's your view on the various L2 infrastructure, and how do you think about it going forward for yourself?
Absolutely. So I guess kind of continuing in the story. So we migrated to L2 about 2 years ago at this point. We're the biggest app built on L2. But actually, the thing that we're building right now is the next version of dYdX. And it's kind of pretty relevant to this conversation as well, in terms of we're actually going to be moving off of a layer two and going back to building our own layer one blockchain that's based on Cosmos. But I'll kind of take a step back and talk about how we kind of came to this decision. So there's a couple different places you can build smart contracts on, and we've touched on a couple of them already. You could build them on an existing L1, whether that's something super decentralized like Ethereum, something maybe more performance like Solana. Slightly different trade-offs, right? But all kind of the same concept of you just build on a general purpose smart contracting layer one blockchain. Next place you can build is L2. I talked a little bit about zero knowledge based rollups. These are cool because they use this super fancy crypto primitive called a zero knowledge proof to effectively compress more or less unbounded amount of data into a really small proof that you can just put on the blockchain. And that's where all the scalability comes from. So these can be really cool because they can serve a pretty high amount of throughput without sacrificing on decentralization at all. The next kind of type of rollup you might consider is an optimistic rollup. So the leaders here are Optimism and Arbitrum. Optimistic rollups, it's a fairly similar concept to zero knowledge rollups, where you have to roll up. And what roll up just means is that you're building on top of another blockchain, and then you're posting proofs or whatever you need to post back to the layer one blockchain to kind of ensure all the computation happens. I won't go too deep into how exactly optimistic rollups work, but they are pretty cool as well because they can support the EVM really easily. So a lot of existing smart contracts can be easily ported to them, which is, at least for now, less so the case for zero knowledge rollups. The other thing you might consider with rollups or any chain that you're building on is what's the level of scalability. I usually think about this in terms of like how many times more scalable is a given other chain or rollup relative to Ethereum. And just to give you kind of an order of magnitude sense, optimistic rollups are roughly like maybe 10 to maybe 50 times as scalable as Ethereum. Zero knowledge rollups are probably on the order of 100, maybe a little bit more times as scalable as Ethereum, and some other layer one blockchains, or like Solana, for example, are probably like 300 to 500 times as scalable as Ethereum, at least for right now. And all of that will improve over time, but that's where we are today. So obviously, I think rollups are cool in terms of dYdX is built on one of them right now. So how do we kind of arrive at this decision to, at least for now, abandon rollups and go back to building our own layer one blockchain? It's effectively based on what I just said. It's like, what is the level of scalability that you can get on any one of these platforms? And kind of the unique problem that we had to solve, which I touched on before for dYdX, is how do we build this decentralized order book and matching engine? And order books and matching engines have a couple interesting properties. First, like I mentioned before, they require a really high throughput. So on the order of at least 1,000 orders placed and canceled per second. And then if you want to be a super serious exchange, orders of magnitude more than that. But the other interesting property that they have is that most of these orders that are placed don't even result in trades. So it's mostly just market makers quoting, and roughly 1% of the orders that are placed will ever get filled. So we took a look around when we were thinking about how do we decentralize this order book and matching engine, and asked the question of all these different technologies, okay, which of them can support this 1,000 orders placed per second that we want to offer to our users? And ideally, which of them can support it with very low gas fees, right? Because if you're a market maker, you don't want to have to be paying a ton of money just to put quotes on the book. That'll really negatively impact liquidity. So we asked this question, we learned a lot about all these different technologies, and we got the answer for ourselves back that none of them can, like not even close. No blockchain or rollup can support anything close to 1,000 transactions per second right now, all with very low fees. Like maybe Solana could kind of get there, but we don't have 100% of Solana to ourselves, and it would still cost a decent amount of transaction fees. So how are we doing it? Like, how are we building this decentralized order book and matching engine? And why did we pick this new technology in Cosmos to build on? It's because we kind of came up with this core concept that's pretty novel, actually, that you can run the order book off chain, but in a decentralized way. And what I mean by that is you can have all of the validators, which are effectively the same thing as miners, but in proof of stake, run the order book off chain and then only put on chain the actual trades that happen. And this is really cool because the big bottleneck in blockchains is coming to consensus, which basically means whenever you put something on chain, it's not going to be very scalable. But if you can put things off chain and it's just running on kind of a distributed network of servers, potentially in parallel, you can scale that up much, much higher, and it doesn't cost any gas fees. So that's fundamentally what we're building in dYdX v4. And we could uniquely do that because what we're building in dYdX v4 is our own chain. And the software we're using to do that is Cosmos. So you're effectively building the software that the validators will run. And it gives you access to a ton of things you couldn't do if you're just building on Ethereum. Like, we don't really have any control over what Ethereum validators do. We can't try to incentivize them to run the dYdX order book in parallel, right? And parallel with the rest of all of Ethereum. But with building our own chain, we do have access to that. And I think that made it a pretty uniquely good solution for what we're building. If you ask me the question, okay, so do you think that Cosmos and app chains are objectively better than all these other blockchain solutions? No, definitely not. Like if I were building something like a lending protocol or potentially even a Uniswap, composability is really important, right? So being on the chain that a bunch of other things can be built on, having it be general purpose is super valuable. But for us, kind of the trade-offs made a lot of sense to build our own chain. And that's what we're working on and plan to ship later this year.
That's really exciting. And I'm very interested to see how it plays out. There's been quite a lot of technical innovation in the Cosmos ecosystem. The shapes of things that are in Cosmos are different from what we see in Ethereum. What's your feeling about that ecosystem? How do you think about it? Like, is it the technical experimentation lab and then the rest of the stuff will get integrated back into kind of like the core Web3 underpinned by Ethereum? Or do you think it's a separate competing world that is on a different infrastructure?
I'd say it's more of a separate competing world. Certainly there are things that it might make sense to build on both chains. But Cosmos is still relatively new. I mean, there are a few sort of moderately big DeFi projects like Osmosis and a few others on it. But one of the other things that I think at a high level is that people think of blockchains too much like communities and not enough like technologies. And what I mean by that is I feel like just because all of these things are priced, there's really big kind of community mentality around a given blockchain, right? It's just like, like people think Ethereum people are different than Solana people are different than like, I don't know, Aptos people or whatever. But I think at the end of the day, really where all of us need to go in DeFi is focusing on the product and building the best possible product such that people don't even care what technology is built on, right? Like, do you care if your local website is running on Google Cloud or AWS? Like, no, of course not. It's sort of ridiculous. It's just like you care about the product experience at the end of the day. So I kind of touched on why we feel like Cosmos for us is going to be the best possible product experience. There certainly is a community aspect to any of these chains, because there are a lot of sort of common goods that you can use, right? Like, for example, the USDC team in Circle just announced that they're going to be deploying USDC onto a brand new app chain that's built in Cosmos. And that's awesome because Cosmos also has this primitive called IBC, which is basically just a super decentralized and secure bridge. So it's like easy to bridge assets across chains in Cosmos. But from a product perspective, like when people are using dYdX v4, I don't even want them to know or have to know that they're using Cosmos. Like, they shouldn't care. You're going to be able to sign in with your existing wallets. Like, you can still use MetaMask, Coinbase wallet, whatever. You won't have to go to any bridges. Yes, there will sort of be some bridging that's happening under the scenes, but from a user perspective, you'll just see deposit to dYdX. And then it uses a bridge behind the scenes. Like, that's a much better UX than sort of shipping somebody off to your sort of janky looking bridge site and then be like, okay, come back once you've braved the bridge and managed to get your assets over to this given new chain. So I think all this stuff has a long way to go from a UX perspective, but that's the main thing that we're focused on at dYdX.
One last question I have for you is around the changing shape of how DeFi protocols are run. And, the context for that is that projects now are kind of splitting into a labs entity that develops software for a protocol. And then there's a foundation entity whose job it is to write grants and represent maybe like a DAO and full decentralized community. Can you talk about where dYdX has landed and sort of like what your considerations were and how you think this is going to evolve?
Yeah, so that's basically the structure that the entire dYdX project has taken as well. There's sort of a, quote, labs type entity, which is the one I'm the CEO of, and we're developing some of the software behind the platform, of course. Then there exists the dYdX Foundation, which has existed for almost 2 years at this point. They launched the dYdX token. They, like you mentioned, are kind of responsible for administrating governance, for representing the community and helping the community figure out who they're going to give grants to, stuff like that. But we're taking this really seriously. And I think we're trying to find just the optimal middle ground sort of between how can dYdX continue to be a really high quality product and also how can it be governed by the community. And I think the combination of those two things is what makes it really hard, right? You could sort of a spectrum. Like if you went full decentralized and are like, okay, there's no company anymore, then it's harder to make things happen, right? But if you're totally on the other side and you're like, no, like we're going to own all of the development and all of the decision making at our company, we don't really care what the community says, then how are you ever going to build something that's decentralized? So I think we've kind of adopted a model of progressive decentralization at dYdX in terms of both the organizational structure and the product itself. So as I've been talking about, the V3 product, which is the current one, is sort of hybrid centralized, decentralized, and then V4 will be full decentralized. And that's something that I think is being mirrored in the project's, quote, organizational structure as well. One of the cool things that we've been able to observe on dYdX is we actually have a ton of really good organic governance activity going on. And I think the reason for that is because we're focused on more advanced traders and trading firms as two of our biggest user bases. And trading firms especially have become really active in dYdX governance. Like they're the ones that are putting out pretty much a lot of the proposals, are voting on them, discussing them on the forums. And it's really starting to come to life, this kind of dream of, can you have a financial product that is governed by its users? And that's exactly, I think, what we're starting to do. So still have a long way to go, but I am certainly looking forward. It'll be interesting kind of seeing how both dYdX and a lot of other DeFi projects evolve from an organizational perspective as well.
Really fascinating stuff, and I appreciate the detail and clarity with which you've gone over the topics we've discussed. If our audience wants to learn more about the project or to follow you, where should they go?
Yeah, so our website is dYdX.exchange, and there's links to our product, to our Discord there. And then you can also find us on Twitter at dYdX or me at Antonio Juliano. And thanks so much for having me. It was a great conversation.
Oh, my pleasure. Thank you so much for being on. I'm excited to have you back on when the next version launches.
Sounds good. Until then.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.